Hi, this is Andy Hoffman, Media Director of Miles Franklin Precious Metals, and I'm here to talk on Friday, January 10th about this week's goings-on, of which there are many. Now keep in mind, the first thing in my notes for this blog, which I wrote Thursday afternoon, was the 3% yield resistance on the benchmark 10-year Treasury bond. Just like we've seen the line in the sand at $12.50 in gold, $20 in silver, and many other levels over the years, it's quite clear that for the past, let's call it 4 or 5 months, but particularly the last 2 weeks, there's been some force out there that desperately does not want rates to go over 3.0%. Remember, the 10-year Treasury yield is perhaps the most important yield in the world because more other interest rates are set off of it, particularly, let's say, U.S. mortgage rates than anything else. For instance, yesterday afternoon, remember, we were supposed to have this extremely bullish NFP report this morning based on the bullish ADP report Wednesday. And miraculously, late in the day, with Treasury yields right at 3.0%, they had a amazing Treasury auction for 30-year yields. Now, one would be asking, why would someone be aggressively buying long-duration 30-year bonds right before a supposed big unemployment report? And of course, the answer is it was the Fed doing it. Heck, the Fed admits to monetizing more than 70% of all the Treasury offerings over the past year, and as we kind of proved here, it's a lot more than that. So yes, they are terrified of rates going up because the entire financial Ponzi scheme with this parabolic debt growth worldwide requires ultra low interest rates, and that's why we believe tapering was just a mirage, as we wrote about earlier this week, and why it was necessary to create a, quote, worse than expected NFP report this morning, which they certainly did in an incredible way. Now, just to go back to how this whole tapering thing started, remember, Bernanke, his term ends on January 31st. His legacy will be that he came into office in early 2006, took rates from 5% to 0 and left them there, and expanded the Fed's balance sheet from $800 billion to $4 trillion. And it's probably a lot more than that when you consider what they're doing off balance sheet, such as the secret loans we know about now, the swap agreements with European banks, and of course, as I mentioned in what we wrote, Tapering Mirage last week, we think that they've been doing far more QE than they even say, perhaps twice as much as that. Now, at the time, back in May, the 10-year yield was only 2%. Stocks were going up. The cartel had been smashing gold and silver, and he figured this was a good time to throw in the maybe we will taper if things get better. The problem is, just by making that statement, rates started to rise sharply, and by September 5th, they were up to 3.0%, which is exactly why, what a shock, the September 6th NFP report was worse than expected, enabling them to get rates back down again to the 2.5 level. But then after Thanksgiving, the old, we got to push stocks up for the end of the year for Wall Street started, and you started to see these ridiculous diffusion indices get stronger. And of course, the November unemployment report was better than expected. And by the way, remember, it came out just as we found out that the November or the October 2012 report was completely fabricated, but that's aside from the matter. And as a result, rates pushed back up against 3.0%. And that's why you saw this really, really bad report today. In fact, it probably should have been a lot worse than they were even saying. I mean, it's amazing. Wall Street was expecting 200,000 jobs to be reported for December, and it was only 74,000. And of that, more than half were temp jobs. But the thing that amazes me, now we had predicted here, now the street was saying the unemployment rate will stay at 7.0%. We had said it's going to go down to 6.5 or below because the 1.3 million people coming off the unemployment benefit payrolls in December, which has been very loudly discussed since they're talking about extending those benefits now in Congress. The problem is the labor force, while it plunged by 550,000 people, it should have plunged by twice that. And still the rate went down, the quote unemployment rate, to 6.7%. And probably it will go way below 6.5% next month unless they extend those benefits. Keep in mind, there's another 3.6 million people whose benefits are going to end during the course of 2014. So it's just going to be fighting uphill. And of course, if they do extend those benefits, as they're talking about now, actually they're wrangling, it's this whole bipartisan thing. It will cost $20 billion to extend them this year. Remember, just a month ago, we had this farcical budget deal, which was claiming to have $20 billion of annual budget savings. So they will get rid of them within days or weeks of them initially being announced. Remember, those cuts that they supposedly talk about were mostly back-end weighted, meaning most of them were 8 or 9 or 10 years from now. And from what I'm reading about this discussion in Congress now about extending the 1.3 million people for a year, the Senate Democrats want to, quote, pay for it by reducing certain Medicare costs in the year 2024. No, I'm really not making this stuff. This is actually going on in our Congress right now. Some more information about the end of P report today. Oh, and by the way, that's why the Fed got rid of its 6.5% threshold for ending zero interest rate policy, because it's going to go way below 6.5%, the unemployment rate, because jobs are being lost, not gained. Anyway, back to today's report. Amazing how ADP said that there was a plus 238,000 last month, while the government said only plus 74,000. ADP said there was growth in construction jobs, when the government said that there was, as usual, a loss in construction jobs, and how anyone could believe that construction was booming with the cold December and the weak holiday spending and the high interest rates causing real estate to roll over is beyond me. But then again, we all know that ADP just a year ago rejiggered or recalculated their jobs numbers for the prior year downward by 420,000 jobs. So I don't think, as bad as the BLS is, I think the ADP may be even worse. And the scary thing is the BLS is lying, while ADP is closer to incompetent. Anyway, so as I write here, the 10-year yield is down to 2.88%. Of course, stocks are barely down, because stocks never go down, and gold's up $18, silver's up about 65 cents. Encouragingly, silver's back over that $20 line in the sand, and of course gold is right under that $12.50 line in the sand. These are very important numbers because they have been desperately trying to cap them for so long, and at some point they're going to lose control and it's going to break out. To wit, we can look at the ongoing issue with the COMEX December gold contract. I see last night that finally 63,000 ounces left the registered inventory at the COMEX. We're down to only 416,000 ounces. That's, barely $500 million worth of gold supporting this 100-to-1 Ponzi scheme of paper to physical, in which somehow they're able to price the metal, be the primary pricer of the metal every day. It's incredible. And remember, there's still another 200,000 ounces. Here we are on January 10th. Still another 200,000 ounces standing delivery for December. And the gold hasn't left registered. And if it doesn't, that's a default. I don't care anyone, they could whitewash it all they want. The whole world will see that people stood for delivery and the gold didn't leave. Much like the German gold, which was another story. And if it does leave, well, we'll be down to 200,000 ounces, which is nothing. There might be 50,000 entities on the planet that could take that out in 2 seconds. So that's nothing. And so we'll just have to keep watching what happens. By the way, did anyone see the precious metals flash crash on Monday? Look, I've seen a lot of things over the years. In fact, there's probably been 200 mini flash crashes alone last year, where suddenly prices plummet, usually at the same times of day. Remember at 2:15, the open of the London pre-market, we've seen gold be hit on 90% of the trading days since the middle of last year. And of course, the COMEX open, the 10 o'clock a.m. Eastern Time close of the physical markets, and the 12 o'clock cap of last resort. But anyway, in this particular case, it was particularly egregious. It was the 6th time in 4 months that the COMEX has had to temporarily shut gold trading because of the lack of liquidity. And basically, we saw someone put 4,200 contracts on the market at market at once, worth more than $500 million. Basically, all of the registered inventory, and gold fell $30 in, seconds. at least in the first 2 or 3 seconds, I saw gold fall $15, and I've never even seen it fall that fast. It didn't fall. It literally, the price just changed from like one price to another price, $15 below that. And oh, by the way, gold was just about at 1,250 when that happened. So, you know, the desperation is evident, and it's going to get more so, the desperation, as the physical demand continues to pick up. Now, overseas, we had another ECB meeting on Thursday, and Goldman Mario Draghi, I say that because he was, you know, yet another Goldman Sachs employee who now is a major central banker. They held the rate, their benchmark rate, at 0.25% amidst record low loan creation in the whole Eurozone. Yes, you know, you're seeing now the hyperinflation of some of the stock markets in Europe, like Greece and Italy, and meanwhile their economies are collapsing. They announced another record high unemployment rate in Europe just last week, record high youth employment in Spain and Italy, Greece, all these things. It's getting worse over there, not better. And Draghi's comment was, "We firmly reiterate that we expect the key ECB interest rate to remain at present or lower levels, lower than 0.25%, for an extended period of time, as the Governing Council strongly emphasizes its intention to maintain a accommodative monetary policy stance for as long as necessary." And this atop very weak Chinese non-manufacturing data earlier in the week, and calls for increased Japanese QE, if you can believe it, as the massive, and people forget about this, the massive hike in the Japanese sales tax from 5% to 8% commences in April, which is just 3 months away. To offset it, Shinzo Abe is proposing a $50 billion stimulus bill, including handing out checks to citizens, in yet another blatant example of money printing. And better yet, that sales tax is then scheduled to increase to 10% at the end of 2015, no doubt due to more necessitating more money printing. Of course, by then, this mad experiment in qualitative easing, that is, doubling Japan's money supply in just 2 years, will be nearing its end. Actually, it'll be at its end, because it's, I take it back, it started in April 2013, so yes, it'll be at its end. So take a guess what they're going to do next, if hyperinflation hasn't already overtaken them. And oh yeah, their quarterly consumer sentiment survey, this is for Japan, it was just published yesterday, depicting the biggest 6-month collapse since 2007, not uncoincidentally matching the plunge in AB's approval rating to a record low. So yes, all over the world, surging stock markets while everything falls apart. I think, again, you have to look at Venezuela as the poster child of the beginnings of hyperinflation around the world. And, you know, these things, this is just like Weimar Germany, it's like Zimbabwe, it's like what we may be seeing in Greece or even here in the States, where it starts out appearing to be nominal, and then all of a sudden the real losses mount, and the only things that really survive are gold and silver and items of real value. You know, stocks are struggling here, but who cares? They're barely down. You know, CNBC may say, my God, the Dow's down 30 points, but the fact is it's still sitting near its highs. What's more troubling is high yield credit is starting to really crater. These are the things that you really need to watch when people are scared of what companies are going to be doing, not about their stupid stocks, which are propped up by the PPT and the Fed. Now, in last week's Charts Even We Can Appreciate article, we posted a remarkable chart of the MACD technical readings of various markets. MACD is the moving average convergence divergence, and, you know, needless to say, you can use it to measure, quote, overbought and oversold for whatever that's worth in a manipulated market. It does mean somewhat something, though, when you look at a 30-year chart, and those charts showed gold and silver at their most oversold levels ever. I mean, ever. Far below even 1980, let alone 2008. And stocks are at their most overbought level since the top of the 2000 tech bubble. So this shows you just how much damage all this government intervention is creating. I mean, everywhere you go, you're seeing these kind of things in markets, these dislocations, which eventually have to break. This week we followed up that article with one titled "The Most Lopsided Trade in Financial History," depicting how the largest COMEX commercials, like JP Morgan, are holding their most bullish position since the PM bull started 13 years ago. while the large speculators, who are always losing to the all-knowing, deep-pocketed commercials, have never been more bearish. And right as prices have fallen below their respective costs of production, this has happened. So, you decide which way you think things are going. And then, of course, we have this issue with the COMEX having almost no inventory left. So I think, again, for what it's worth, extremely bullish things going on there. And then finally, I'll just make one more note. Typically here at Miles Franklin, we don't typically talk much about numismatics. Generally speaking, we favor bullion coins because there's no subjectivity in the value of a coin that's trading near melt value. However, from time to time, we do come across numismatic opportunities that are worth taking a look at. I mean, we're always positive on numismatic coins when they trade near the value, near melt value. But in this particular case, we have an actual numismatic opportunity. Andy Scheckman did a special post this week titled "Once in a Lifetime Numismatic Opportunity," where he says we just were able to get our hands on some of this what's called Bank of Canada hoard, a bunch of coins from the turn of the last century, which most of them are going to be destroyed, and the rest are being offered. They're Bank of Canada coins. And I think you should read the article, and if you have any questions, give us a call. This is not an endorsement of them in any way, other than to say I think you should just read the article. Well, I think that's enough for this week, and I hope you all have a great weekend. Thanks a lot.